You can lend out your house on Airbnb. You can lend out your car on a platform called Turo. You can lend out stocks in your investment portfolio. Yeah, it's a thing. Securities lending, stock lending is what it's called. And we're going to talk about what that is and how it works. Our guest is David Mack. He is Executive Director of Securities Finance at Wealthsimple. Hello there.
Hello, Bruce. Thank you for having me.
Stock lending seems like a super simple phrase. I've got some stocks in my investment account. You want them for some reason. I lend them to you. Is it as simple as that?
It really is as simple as you've just described, Bruce, to be honest with you.
Why would
Our
I want to do that? And why would you want to borrow them?
so our program helps facilitate or helps to monetize assets that clients are holding in their existing account. As you know, in all walks of life, different investors have different time frames, and some of them have a long-term vision, some of them have a shorter vision. But at the end of the day, our objective is to help our clients achieve financial freedom. And by doing that, we're trying to create a passive stream of income within their existing portfolios. And securities lending or stock lending in this particular case happens to be an avenue whereby our firm, on behalf of the clients, will take their assets and make them available for individuals that are on the street to borrow them. And in return for that, our clients get paid a fee.
When I loan out my house on Airbnb, I am taking some risk. They might trash my house. They might decide never to leave. Like there's a risk factor that you expect to be rewarded for. What are the risks for me that someone's gonna, you know, run off with my shares in AMD or Google or whatever it is that I'm lending out?
Fantastic question. And in today's environment, as we can even see today and throughout this past weekend, the concept and topic of risk is a very real one. Um, in our existing program, the way it happens to work is any shares that you happen to lend out, you give and make available for third-party individuals and investors and funds. The shares that we do lend out are in turn collateralized up to 100% and given full market value in exchange for those shares. So if I lend out your shares, Bruce, we will then receive the equivalent dollar cash market value for those shares in return. Those shares act as a source of collateral and are marked every single day to ensure that you are 100% fully covered. And adding further to that, an extra element or layer of risk protection for the clients, the cash that is received from our borrowers that is then shipped to us, we actually move them off book every single day into a big bank trust account to add that additional layer of security and safety to ensure that your assets are safe and the collateral as well.
You've got an example on your website. It says you've got 300 shares of a high demand stock trading at 20 bucks. So total value 6 grand. The return on that loan works out to be about 4%. I'm oversimplifying the example dramatically. Is that the best way to think of sort of what this would be worth it to me, an additional 4% return? So taking capital appreciation or dividend or anything else out of the equation, that it might be worth a 4% return. Have I simplified it too much?
No, you have not. And that is exactly how we want our clients to view it as. If if you're being told you're going to earn 4%, as in our example on our website, you will earn that 4% return on an annualized basis. And it really is just like any other savings account or interest rate earned on any type of asset you might have. It is treated in the same manner.
Right. And so for an investor who does have an ambition for that capital to appreciate over time, I'm again oversimplifying, they may say over long periods of time, lots of swings up and down, and past performance doesn't indicate future returns. Let's say that stock is up 8% a year. Now I'm getting 4% because I'm stock lending. So in theory, based on my uber simple math, that return could go from 8% to 12%. Fair?
That is correct. Absolutely.
Uh, for the borrower, what are they doing with it? With my house, they're, staying here because they're visiting family, because I wouldn't ever loan my house to people who are going to have a party in it. What are the borrowers doing with this stock?
The borrowers who take our shares have the ability to utilize them for any particular purpose that they may have. Oftentimes, they are using it to employ a particular investment strategy, perhaps to hedge a position they have with an existing mandate they have in their internal portfolio, or even as simply, they could be using the shares that they borrow from us as collateral for pledging, for example.
Hmm.
There's really there's no real formula for what they can or cannot do. It really is up to them and at their own volition as to what they want to utilize our borrowed shares for. The key is that whenever we need them back, we can get them back.
How do you make your money?
So our firm will lend our shares on behalf of the clients, such as yourself. We will charge the borrower a fee. The fees are accrued every single day, just like any other interest rate that you earn in any interest-bearing investment. And when that borrow is returned or those shares are no longer required, they're sent back to us. We earn our revenue off of that fee that's charged, and we share them with our clients.
And what would be how should I think about that fee? I think an ETF, an exchange traded fund, might have a 20 basis point fee. Wealthsimple's portfolio might be 60 basis points. A Canadian equity mutual fund is going to be 2.3%. I know we're not talking apples to apples here, but what would that fee be for Wealthsimple? How big an idea is this for you from a revenue standpoint?
Yeah, I mean, if I can oversimplify it just a little bit, the fees that are generated from us performing our lending activities on behalf of clients can vary on a case-by-case basis, on a day-by-day basis. It really is determined by supply and demand factors, scarcity, as well as general market premiums that are derived for that particular underlying security. So whatever happens to be a higher premium security will generate a higher fee, and those that are lower premium securities will generate a lower fee. At
For
the
a
end of the
borrower,
day,
for a borrower, is it a percentage? Is it like a stock trade, like 9.99?
for a borrower, it's all treated in percentages.
It's
Of course, they
gotcha.
can, yeah, of course they can convert that to their, the nominal dollars and notional dollar amounts. But at the end of the day, we're talking about percentages back and forth.
Why are we talking about this now? Has this always been a thing, but under the radar, or was there some sort of a change that made it easier? Because I'm going on I go to my big bank and I'm getting ads for stock lending that I'd never even seen before.
That's a great question, Bruce. So stock lending for retail clients has always been around yeah, in the United States and in Canada. And to be quite frank with you, the concept of fully paid lending, which is our particular business at Wealthsimple, it's a more relatively newer program that actually started to form probably just prior to COVID. The advent and the encouragement for it to grow so much in the last couple of years has been the proliferation of retail permeating overall markets. As you can probably imagine, the influx of retail investors and their increased ability to gain information, dissemination, and to be able to control their own finances, at the touch of the phone using the Wealthsimple app, for example, if I can use that plug.
Hmm.
It's become so great and so vast now that because of the amount of retail investors getting actively involved in the overall lending, in the overall investment space, the ability for them to lend their shares has become far greater.
Hmm.
The increase in the proliferation of it has thus come in tandem with the increase of retail investors jumping into the market.
It is not every stock that someone is going to be interested in borrowing. What would be some criteria that we should think about of stocks that would be really of interest?
Yeah, I mean, if we want to look at it from a regulatory perspective, we worked really closely with our regulator, Turo, our national Canadian one, and they've been very great in working with us as well as all of the participants on the street in the stock lending world to determine what securities are actually allowed and which ones we shouldn't be using and so forth. So there are specific parameters that we adhere to that
I'm
we
more
follow.
interested in what people would want to rent. Like they may not want to rent a boring old stock, but they may be super excited to rent one that's extraordinarily volatile because it would, for someone pursuing a short strategy, would be more relevant to them.
Generally speaking, more volatile securities and more volatile stocks have a higher premium attached to them just due to that volatility. So because of that, those big swings in the market that we can see on a regular basis, there is a general inclination to lend higher volatile securities and therefore earn a higher return of revenue associated with that.
What are the implications in terms of the lender's ability to sell the shares? So I know that if I've rented out my house and I've made a contract with someone who's going to stay here, I can't suddenly sell it, move out, and just ignore that I had made that commitment. How locked in is the stock lender here?
And that's where I think we're a little bit different and perhaps a little bit better than the traditional Airbnb example. Um, in the case of a lender or a client who's providing their shares to an end borrower, they are under no restrictions whatsoever to be held to any time frame or specific period of or length of time to keep their positions available for somebody. They can go and transact in their own account on the underlying shares at their will without any regard to the impact it will be on the underlying or to the borrower who's taken their or borrowed their shares.
So do you swap in somebody else's shares? If I go and sell my shares of company X, the person who borrowed them, they need those shares. Have you got someone behind me who you can swap that in? Another
We
house on
do.
my street, you can say, go stay there instead.
Absolutely. I mean, as you know, unlike houses, stocks are very fungible. So as a result of that, we can swap your shares for somebody else's should we need to.
Wow. Really interesting stuff. David, thank you so much for joining us to talk about it.
Thank you for having me. Appreciate it.
David Mack, Executive Director of Securities Finance at Wealthsimple. He was here to explain the who, what, when, where, why, and how of lending stocks in your portfolio.